Good morning, everybody. Glad to have you with us. I hope your new year's off to a great start. Ours is, and we want to talk with you today about how you can take a more aggressive growth tack to part of your portfolio. This is definitely something where you can take a very small amount of money, as little as $400, and you can turn it into up to $1,100 the way I set my targets with these cheaper options. They're called $1 options, $1 or less. Controlling 100 shares, that means it would cost you $100 or less on each contract to control oftentimes many thousands of dollars worth of stock. We're going to get into that. And reminder that as we get started, everything I share with you today is for your information and education only. Nothing we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are solely responsible for your own investment decisions. Big Trends and staff are not responsible for any trades you choose to make. And not all Big Trends products or services are appropriate for all traders and investors. This is definitely on the more aggressive end of the spectrum, so you definitely should only trade with risk capital that you can afford to take the risk with, and know that there's going to be losses. We're going to help you manage the losses and talk about that as well as the gains. We don't provide personalized financial, tax, or legal advice at Big Trends. What we do is we take our research, we send them out as real-time email and text alerts to our subscribers' smartphones. So we'll walk you through that today. Do consult your tax advisor too before you make any investment that impacts your tax situation. The baseball analogy is a good one for what we're doing here because, of course, if you're not familiar with baseball, the idea is that you're starting here at home plate and you're trying to hit the proverbial home run and round the bases. You've got first base, which we're not after here. The first base is how a lot of traders trade these days, looking for small gains. We look for at least a double in baseball terms. Now, think about this. If you were going to buy at least 4 contracts, the way that I teach this method, I call it Grand Slam options here. So that's the name of it, the program that we send out the alerts on, both entry and exit. Well, if you start with 4 contracts, it costs you a buck per contract, which is controlling 100 shares. So 4 contracts at essentially $100 per would cost you maximum $400. Well, if you buy 4 contracts, you invested $400 to start. If we can get a double, what we do is we recommend you sell half your position when it's up 100%. So think about that. If you took $400 and you doubled it, that's at $800. So the first piece of your profit booking here would be making $400 gain. If you can sell 2 of your 4 contracts, half your position, you'd be up $400. Okay, you hold 2 of those contracts though, looking for more. So if we can get to 200%, the triple on this third base graphic here, that you've got 2 contracts left on your original $100 a piece. They'd be worth $300 a piece. So essentially, what would happen is you would book those, and you would make another $400, and then on your final piece, if you can make the 300%, you only have 1 contract left at that point, so you're making another $300. If you add that up, you're at 400 plus 400 plus 300, you're up to $1,100 of profits, starting with just $400. So that's headed towards, you can see tripling potentially of your money thereabouts. And that's what we're after here. So we're going to teach you about these methods. When you add up the gains and the losses, all trades consider, if I can go to that real quick, this slide shows you that, okay, if you took all my trades on all the callouts that I did, starting with a very small portfolio, you can see even a $10,000 model portfolio would be up to over 32,000. That's 22,000 and change in profits in adding up all gains and losses before commissions. As you know, commissions have come down to next to nothing for option traders. So it's a great time to be trading and allowing yourself to basically keep most all of what you make. And so commissions are a very small part of the equation. We're going to walk you through how we've done that. Looking back over these past 4 years. And you look at recent trade ideas like an AMD, Advanced Micro Devices. This is a tech stock, one of the leading chip stocks out there. And part of what you have to get used to is when you buy these options, even on popular stocks like this for a buck or less. So we recommended the AMD August 75 strike calls when we were getting a signal in the stock and it was in the neighborhood here of about $62. So you say, if you're new to options, what does a August 75 call mean? It means we're buying a right to buy AMD shares at 75 And you can see the stock's at 62. Why would I buy a right to own it at 75 when it's I could have it down here at 62? Because if you're buying the stock at 62, 100 shares of stock costs you $6,200. We're buying the right to buy it at 75 for only $100. So basically, about 1.5% of that. And we're betting that that right's going to get more valuable as the stock goes up, and typically goes, we call these out of the money options, as they go from out of the money closer to the right to buy price, the strike price as it's called, of 75. So you can see in the next couple of days after we got into it, first day actually we were down a little bit because AMD dropped from 62 to $60. We're going to get into the indicators in a second. Second day it runs up here to almost 70, and we're booking our first 100 and 200% gains on that by the end of that second day in the trade. Third day it got up to right at about 72, and we booked the last profit of 300% gain. So that $100 per contract turned into up to $400 per contract over just the 3 days in the trade. So about 2.5 days in the trade. So the point being that you look at this and you say, okay, how do we do this? Well, the goal is we need speed of movement. We need fast moves. We don't want to get stuck on slow boats. So a big part of what you're going to learn here is when something goes overbought here, we're going to talk about these indicators here. And overbought is not the bad thing that most people think. What we look for, though, is when it goes overbought, it's got to keep going up. This one did not keep going up the next day or two after that first overbought signal, so we're not interested in that. We're going to talk about what all these indicators mean in a minute. But this next one here, if you just draw a line and say, okay, is it going to keep going up? That first day after that, it didn't go up, so you wouldn't be interested here. But look what happens. Boom, it explodes even higher, and we've got a check mark to say now all systems are go, with what we call the confirmation that let's face it, the institutions are driving the market, not you and I as individual traders and investors. The institutions that are moving many billions around say, hey, I want more AMD, and they're not going to be able to buy it all at once. So you see that, okay, we get that breakout, they're buying it more, and you want to be a part of that because they're going to keep buying it typically. And so that's what we're after, is that identification of these trends. We're going to talk about the indicators here in a minute, but basically first want to get into some principles. Part of being a home run hitter, like when you think of the ultimate home run hitter back in the day, was Babe Ruth. He held the 714 career home runs record until the 70s. I remember watching with my dad, Hank Aaron, hit his 715th, but Babe's record lasted for many decades until it was finally broken. And the thing about it is he hit 714 home runs. He had 1,330 strikeouts, okay? So the point being that you've got to realize that, when you're going for the more aggressive home run approach, you're going to have more risk as well. And when managing that risk becomes important. What I find that's hurting most traders these days is this four-letter word that's worse than most other four-letter words, and that's the FEAR word, fear. Fear is something that is holding a lot of traders back from making a lot more money in the markets. Sometimes there's a healthy amount of fear that makes sure you don't overcommit your capital. We're very disciplined in making sure we don't put too much into any one trade in our Grand Slam options approach. So that's a healthy thing. But I see a lot of people who just literally cannot pull the trigger in or out of trades, and they basically fear is basically preventing a lot of you from taking advantage of great opportunities. So only do this with risk capital, but at the same time, we always encourage people to start small and build. Even in the pandemic this past March, when the markets were plunging some 30% from their peak to their low in about a month, we were making money, and even on calls we made money in names like Kroger, KR, not once but twice here. This is from our Grand Slams call outs, and you can see this is one where we try to double our money, and if we can double our money or thereabouts, we made, in this first one there, we made 91% the same day. The next trade we did 100% the next morning on Kroger. In both these examples, we're catching these very fast speed moves. Even in a grocery stock like Kroger, we say, okay, we're getting in, we're capturing these quick pops. And the goal here is that trading becomes a lot easier when you get your trade off to a relatively fast start. If you get in the hole really quickly, trading is really difficult and not a lot of fun. It's a lot of fun when you can take your risk capital off, get that double on the first half of your trade, and then see if it's going to go. Now, that first time, look what happened. The stock rolled back down, and we only made 10% on the second half of our position. That's when you're glad to have sold half your position at around a double, because then the second half only up 10%. We averaged still about a 50-51% gain on that trade for Kroger over a couple days, March 5th and 6th last year. Same thing March 17th and 18th, and this time I said, you know what, I'm not going to let this trade slip away from me. I sold the second half of my position up in here, put a big orange dot on it. I sold it up here because I said, you know what, it's losing momentum. I'm going to bail out of it and make 92% of the second piece, and thankfully did before it came crashing back down, and we were not a part of that drop. So the point being that we want to trade these kind of out of bands moves, I call it, where we're moving outside this upper blue line. That wasn't happening on that second one. You can see it was kind of failing up at that resistance anyway, and we got on out, but still made a 96% gain on that whole trade. So let's talk indicators for a few minutes and start to lay some groundwork to have you understand what we're looking for. Commodity Channel Index, as it sounds, was developed to trade the futures markets. Donald Lambert developed this indicator at the start of the 1980s. So we're talking about something that's 4 decades old, and it's an indicator. If it works, I use it. I don't have to develop it to use it. I've seen it to work on a lot of big growth stocks, a lot of big movers up and down. The difference on CCI versus most of your other traditional indicators is that Lambert said, add up the high plus the low plus the close for a given stock, divide that by 3, and you get the typical price for that day or that period that you're looking at. And that's different than the closes because, of course, if the close was at the high, you got 2 highs and a low, that's going to have a bias to the upside. If the close was at the low, it'd be 2 lows plus a high, that would divide by 3, and you'd get a bias to the downside. What Lambert came up with that was the same thing that I've been noticing on multiple indicators that I did this same technique is that when something goes overbought, most people have been trained. If there's one thing I want you to take away from my presentation here today is that overbought is not necessarily bad. In fact, it can be powerfully good in your favor to the upside. Because like I was telling you, if it goes overbought and stays overbought, that's where the institutions are loading up. Same thing on the downside. Watch out if it's going oversold on the stock and it's continuing to stay oversold, institutions are bailing. So when you look back at like Barrick Gold, I've been very bullish on gold. I still am in the bigger picture, but there's sweet spots where we want to capture this. And I was mentioning before, like on AMD, and same thing here. When this one's going overbought, this is a percent R we'll get into next, is the red line here. That's Larry Williams indicator. But there's a CCI going overbought in that blue and yellow line there, right at that peak. If it had kept going, we would have had a good sign here, but instead it failed, and we're not interested. So we stay away from that fake out, and we want the true, what I would call breakout, not the fake out. So notice what's happening. When you get this set up in the overbought here on the percent R and the CCI, the last indicator in green is the ADX. We'll get into that in a bit. That's a key high there. And I'm not buying there right at that high. I'm saying, prove it to me that you want to keep going. Look what happens the very next daily candlestick, or you can see the green close right at the high of that candle, means we're getting a confirmation to buy this thing just above 19 and a half. So we're in there the next morning buying right off of this open here about 19 3/4 on the stock. Now notice, what do we buy? This was in mid-February. We're buying a mid-March 20 strike call. So just slightly above the current price of the stock, and we paid 59 cents. That's $59 to control 100 shares of stock. If you convert this into stock, 100 shares of stock would cost you just under $2,000. We're controlling that for about 3% with a $59 call option. So, of course, at 3%, you can see how your leverage ratio could be up to 30 to 1 in that kind of a scenario when you're paying, you can see less than 30 times the cost of the stock. So the point being that we catch this quick move up from 20 to 21 in the stock. Just a 5% move is good on that first move for a 100% gain. So that's about a 20 to 1 leverage on that first quick pop. Sure, there's some time erosion happening as this goes from out of the money to in the money. You're losing a little bit of time, not much because we're only in this trade for 4 trading days. But what was great about it is that, look, we said hold half your position. A lot of traders blow out their winners way too quickly. And so by holding part of your position, when it gapped up that following Monday, it went from about 21 and a half, open the next Monday at 22 and a half. We said, you know what, we're up to beyond our 200% profit. We're up right around our 300% gain. Let's just take out the whole position, up 289%, and we're going to actually average better than our usual, half out at a double, another quarter out at a 200% gain, and a final quarter out at 300%. So those last 2 quarters average out to 250. Usually we got 289 on the full final half. So the point being that, then we're saying we've gotten our targets, take that windfall gap in your favor and take the money and run. So while it stays overbought here, and a lot of people would try to keep riding it when it's working at a certain level, we say, look, take profits gradually as the market makes them available to you. Another recent name here from this past November was right before Thanksgiving was Micron Technology, another chip stock, MU. And this is another one where you can see we're getting our signal to get into this trade here. It's just started to break out. You can see right here. So we're getting a piece of this in the neighborhood of about 58, 59 bucks. We're buying about 10% overhead, the 65 strike calls out into the next month's expiration, the December 65 call. We paid 68 cents or $68 a contract. So think about that. It's you can see we're pushing up towards just over 1% of the cost of the stock, maybe not quite 1.5%, maybe 1.25% of the stock's value. So again, tremendous leverage. On that very next day, the stock surges up from you can see 58 up to about 62. So on about a 6% move in the stock, we're making almost 106% gain in the call option. We sold half there. Now, this one did not keep going, even though you can see later it did, but that flattening out is not acceptable. After a point, if we give back half of our max gain here, that's usually a tell for us that we don't want to hang around. Even though this one did keep slowly grinding higher, it was too slow by my standards. So the point is that, it did eventually go, but we took the 45% gain in the second half and averaged about a 75% gain for that whole trade in about 4 days. So the point is that don't get stuck being complacent on a trade. If it doesn't fly, then we want to go ahead and say bye-bye. So you can see here, average directional movement, ADX. This is a trending indicator. It tells us if we're in that good trend phase. So what you want to see is that we're starting to trend in a positive trend. The positive directional movement, which is the net new high, should be up, and the net new lows should be down. The DMI minus should be going down. If we're going into an uptrend, you want to see DMI plus going up, DMI minus going down. That's the definition of an uptrend, right? Higher highs and higher lows, not any new lows. So that's a positive directional trend. A guy named Wells Wilder developed this indicator, and this was one that we were trading in AstraZeneca back there in mid-July when everybody was talking about their COVID vaccine that they were working on with Oxford University in England, and saying, okay, when we got that signal, we wanted to buy into AZN calls. Right as it's breaking out here, the stock is about 58 bucks. We're buying the 65 strike calls. Again, about 7 points out of the money. We paid 83 cents. That's $83 to control 100 shares of stock worth about 5,800 bucks. 2 days later, we got our 100 and 201% gain, and that was right into a Friday weekend. AZM was supposed to report their COVID initial results that next Monday morning. We're saying we're going to give this a chance and see if it can pop. You would assume that the news is going to be good, but there's no guarantees of that. We've already gotten our risk capital and then some out of the trade. So even if it crashed to nothing, even if the other piece of our option went to nothing, say the stock gapped down that next morning, we couldn't get anything for it, we would still make money on the trade. Instead, we got a windfall and made more than 300% when it gapped open, and we were exiting in here right off of that gap open in here about 64 bucks. And we're out of the trade. Notice after that good news, you've heard the Wall Street motto: buy the rumor, sell the news. We're exiting on that news just like a lot of other traders, and the stock's popping back down. You see in the next few days, it's below where we were getting into it. So part of this is the proactivity too. That's what we do for our Grand Slam options clients is we send out entry alerts, but we never leave you hanging. We send out exit alerts. I loved hearing from Tim Q. He said, great AZN trade last Friday, kudos. So it's always fun to get subscribers commenting and kind of sometimes amazed at how fast these things can move when they move. Now this one was a little slower. This was one where we'd had a buy signal on Baidu, and I actually bought it on what I call a retest. The retest being that, okay, when it goes overbought, we're getting the first overbought attempt right here. But we're saying, you know what, we want to see what happens with the stock over the next few days. And it did kind of stall right back into prior resistance, we'll call it an R, becomes new support, call it an S. Why does that happen? Because people who were betting on that stock failing, now it's broken through that resistance. They're happy to buy it back around that support level where we bought it there That was October 20th, right before the stock started to pick up. But notice it was a little slow. It's kind of below my big trends band. So we had to kind of bump up into it, then pause back, then bump up into it. Then it started to go. And we got our roughly near double on these next couple of bars there in early November. That one was bought at 98 cents, 98 bucks a contract to control 100 shares of Baidu that was trading above 130, more than 13 grand, controlling 13 grand of stock for 100 bucks. That's like a 130 to 1 leverage factor, right? So even though the stock only popped up to about 140, we averaged about a double on this trade, 98.5%. So the point is that, okay, we're happy to be out of it at that point. And you'll see Baidu's been one of my favorites. Baidu is often called the Chinese Google, search engine giant over there. And you can see there's, when we start adding up these other indicators like Larry Williams' percent range or percent R indicator. Larry's a friend and a true trading innovator who said, what, measure where we are within a range on a percentage basis. And what I found with Larry's indicator was that when it went from a range bound indicator where I could actually draw my big trends bands and show this should be the top of the range right here, give or take. When it's not the top of the range anymore, when this thing's starting to break out, you can start counting out bars where it's staying above that old range high. We're headed into a trend, folks. That's going from range to trend. Guess where I've made most of my money buying options? What do you think, in a range or in a trend? No question about it, trend. And that's why I call my site that I launched in 1999 Big Trends, because the bigger the trend, the more potential you get as an option buyer. Ranges are better as an option seller, but you know what? That's how I really launched my company and have had some of my biggest successes finding these big trends. And so that's the big trends band. Show me that phase there. And this is where I made on that trade Baidu in 4 days 100, 200, 300%. That's an example where you can say, I left some money on the table. And yes, I did. And you know what? If I could tell you you could get 100, 200, 300% in 4 days, would you care what happened afterwards? Of course not. You'd be thrilled with that. And I'm thrilled with that as well. So when we book that, whatever happens after that, we really are so happy to have booked those profits steadily and then taken that money off the table. So here's all the indicators lining up. So you got the percent R, and I've kept it in red to say red's usually bad, right? It usually means stop, not go. But that's how most of these are coded by traditional platforms. Most people saying overbought's bad. But you see, we've gotten our confirmation, we've gotten our profit. There's the CCI in yellow on this chart. This is a TradeStation chart, and I've got some Thinkorswim charts in here as well. And then there's the ADX. ADX in this indicator, on this particular example, was actually trending up earlier than the others. It's usually a little bit behind, or CCI might be behind. Percent R is usually the first one to signal. The other ones kind of confirm it. I need all three legs of the stool to be working to tell me that this is a trade I want to take. So notice I've got my ADX right here. It's starting to trend up, but it's not really quite doing what I want. It's right after an earnings gap right there. This was earnings right here, okay? It's got the earnings per share. You say, look, I'm looking for, there's percent R starting to go, and then CCI is starting to go, and everything's starting to go. We're getting kind of a triangle pattern here where we're starting to break out of this triangle, and I'm like, okay, this thing has sort of squeezed in here, and now to me it looks like it's ready to go to the upside. It was a good earnings reaction. It held that, but we've kind of calmed down the option premiums too right after the earnings. I don't like to buy right in front of earnings. There's only one time that I'll hold something in front of earnings. I'll tell you about that in a little bit. You see, this one took longer than 4 days. It took a whopping 6 days to get my 300% gain. Still not too bad, right? What I love about this is that once you take your profits, and I said you shouldn't care what happens after that. Some people will almost email in or send me a note and say, oh, I'm still holding here and I'm making more money a couple days after you got out. I put a big question mark on that and say, should you keep holding that? You can see 2 days after that, you're really glad that you're out of that trade, and then it keeps dropping all the way back below where we got in a couple days after that gap down. So you don't want to get greedy, folks. Greed is not good. Greed can really hurt your trading. So take those profits gradually but steadily as the market makes money available to you. When I launched Big Trends in 99, I did it based on buying high delta options. That was basically saying more in the money options, creating more stock substitutes. I was making sure that I could, set myself up to launch bigtrends.com at the end of the 90s. And my trading's evolved because, I was always worried about theta, and you have to definitely worry about the time erosion in any option you buy. But what I've learned is that when you can focus on high gamma, I don't worry about vega because it's an earnings-based volatility implosion is where you'd worry about buying right in front of earnings. That's what I don't worry too much about when I share with you the one earnings trade that you can make with this system. Rate of change of delta is what gamma is about. So the faster you can pick up delta is what gamma means. And you know what? That's where it's usually a slightly out of the money option has the highest gamma. You will pick up the most deltas with a 1 or 2 strike out of the money option usually. So this is a great example of that, and also a great example of why I don't use just price stops, but also time stops in the early going of a trade. This is Morgan Stanley. You can see there's my CCI starting to break out. There's my percent R starting to break out on that bar. And guess what? It's got to close above that high. It does it right there. So we get in actually the next morning's open right here, and you can see we're badly wrong on that first day. It started at about 47 bucks, and in 2 days we're down to 44 bucks. We've lost about 7% on the stock, and my option's down more than half. But what I do is I do what I call a 5-day time stop. So the first day, I'm really wrong. Second day, it's still wrong. Third day, it's climbing back. Fourth day, you can see it's back. And then fifth day, we're back right to where we got in. If we were down from where we got in, we would get out. But then sixth day, we're positive, and seventh day, we're cashing it in. So in 7 days, when it gapped up, so you can see from the entry at about 47 bucks, we bought the 49 strike calls. It went from 47. When we exited up here, it's about 51. Okay, so that's our exit. We're cashing it out at these. Actually, we started off at a 247% gain. We started putting trailing stops in, and it started reversing. We said we've got to book the rest of these profits, and we averaged a 220% gain on the trade. If we had taken our stop down 50%, we would have given up 270 percentage points in collective profit by taking a 50% stop. I see a lot of traders who turn a winning strategy into a losing strategy by doing the wrong thing. So our philosophy is give it 5 days to overcome this time decay curve. The time decay curve is what you have to overcome as an option buyer. It's why most people think that they should be selling options and taking advantage of time erosion, because we know 24 hours in a day, 7 days in a week, et cetera, right? And price action is not as known. But if you've got a trend advantage, we believe you can overcome it, especially a big trend advantage. Where do we like to buy options? Usually out here in about the 30 to 40 day window. And you can see there's a sliver of time coming off of these trades here in a 5-day window. And it's definitely eroding faster and faster. As you get to about 14 days before the expiration, we don't want to mess with this speed of time erosion. So with 2 weeks to go in an option, we typically said you should be out of the trade with 2 weeks before it hits its expiration, no matter if it's a winner or a loser. But if you're just trying to catch a 5-day window in here and you say, okay, I can handle this kind of erosion, why wouldn't we say, look at how much less erosion you have out here 120 days from the expiration? Why wouldn't you buy those options? Because you've got to pay way too much time premium, and it kills your leverage potential. So where I can be making a double, a triple, a quadruple even, plus 300% is a 4-bagger, you're not going to be able to even double your money on a 4-month option if you get that same kind of move, because you just paid way too much time. So for me, about 30 to 40 days out on an expiration is a sweet spot. Even a name like Zoom Video, we traded it back this past spring because it made what I call a low-risk retest that held its key support. Here's our low-risk support level, and it's also coming right into our big trends lower bands here in black. And this was, you can see April 6th and 7th. On the 7th, I got into the trade. You say, well, gee, you're buying, when the stock's trading about 115, we're buying a 200 strike call for $1, $100 a contract to bet that the stock's going to be at 200 plus. You say, that sounds like an insane bet going out about a month out to the mid-May expiration, maybe 5 weeks till expiration. Well, what I say is start counting your days and say, how are we going to do on the trade? Because one of my subscribers even said, hey, it just had bad news. What are you doing? Why are you buying this? I said, well, we think it's a low-risk entry point. After 5 days, we were nicely profitable. 6 days in, we're hitting on the 6th day, we got 101 and 200% gain. 7th day, it was starting to stall. We took 117% on the last quarter of the position. And we said, we're done with the trade. It's run up into my upper big trends band's resistance. You can see it dipped, then it came back up, then it dipped again. The point being that we caught the sweet spot of this move over that 7-day window and captured those 100 and 200% gains. So the point being that even though the stock did not get to 200, it only went to about 155 on that move. Still, from 115 to 155, pretty nice 40-point move in our favor, right? And that's how those out of the money options get priced more and more valuably, and thus more and more able to cash out of it as it moves closer to the strike price. You can see some of the names I love to trade here include Alibaba, Baidu, a lot of tech. You can see Microsoft, some of the big credit card companies like a MasterCard or a Visa. Obviously, Tesla's gotten harder to trade in more recent times because it's so expensive. It's hard to even find a $1 option. So I got to say it's probably off of our list these days, sadly, but it is the way it is. But, there's plenty more opportunities. Schlumberger, and plenty more to go. But a lot of tech, some of the casino stocks and wind resorts or Vegas Sands, these test really well both on the upside and the downside. Some of the big financials like a Goldman. So the point being that, as long as it tests well, you can take advantage of it. Even a name like Best Buy, the bricks and mortar electronics retailer, certainly another one that's done really well for us. You can see in this example, we bought 67.5 calls when the stock was around 62.5. So about 5 points out of the money. And for the first couple of days, we were wrong. Then by the fifth day, we were right again. So we're still okay based on our 5-day time stop rule. If it's flat or against us, we're not going to be as interested in holding that position. We got 100% and then 200%, and then the final piece was triggered out on a trailing stop up 118%. So we don't always, obviously, we can't always get those targets, and we've got a plan for you, and we always tell you when to get out, win, lose, or draw. Here's another Best Buy example where we were catching it right off another retest trade. The CCI retested right here, percent R retested again right here. We said we've got a low risk entry right here to get into this trade on a retracement. The structure of the trend is still good, and the ADX, the green line, we haven't talked a lot about that, but the ADX was still going up. That's what you want to see in a trend is ADX should still keep climbing even if the stock price action pauses. You shouldn't just be reactive to price action. You should have indicators that tell you that the trend is still your friend or not. So then as it rallied, we took the 102% right into earnings, and then it didn't fire right after earnings, and we said we're going to sell it up 75%. That earnings trade has to be taking the profits have to be in your pocket before the earnings date and earnings reaction hits. So you have to have made 100% before the earnings hits and sold half your position. If you have your risk capital in your pocket with this strategy, you can hold the other half into the earnings report, but only in that case. We'll show you one more example with that with Microsoft here in a second. One of the unique things that I do, having traded options myself for more than 30 years, and now we're on a 22nd year here at Big Trends, is looking at an option chart. What does an option chart tell you? It factors in not just the stock price action, but also the time and the volatility components into the option chart. So with Microsoft as a prior example, we were getting our signal. Obviously, all systems were go. This thing broke out here on percent R and CCI right there, but then the ADX came on a little bit later. So we're hopping in here saying we need to buy the out-of-the-money Microsoft. This is a while ago, the 80 strike calls when the stock was back around 77. And we sold them out. We bought them for 55 cents, sold them out at $1.10 with about a week to go before the earnings. When it gapped up on the earnings, we've made our home run. After having our double risk and capital back in our pocket, we were able to roll the bones on the earnings and made 756% in 11 trading days. You can see when you look at the options chart on that November 80 call, it was just getting going on the percent R, the CCI, right about the time we were taking our double. Look at the time that the ADX was getting going. It was starting to look pretty good even when we got in, but we didn't have a lot of data yet. But as the data continued to pour in, everything was all systems go, including a percent R retest that held around $1 right before the earnings. That made us confident to hold it, and when it opened at 471 on the 5-point gap up, we cashed it out at that 756% gain. So that's where you can really make some dramatic windfalls on earnings gaps in your favor. And if it gaps against you, you've gotten your double out in the first half. Even if it went to nothing in the second half, you wouldn't have worse than a break even on that trade. So risk reward's really in your favor. So when you start putting this gamma boosting effect to go with the option charts and about now 50 plus stocks that we follow that are tailor-made for this strategy, high activity, high liquidity stocks that trend well in both directions, you can really take advantage of it. In the oil sector, Schlumberger. This was actually one that I had watched for months in this example. Basically that prior fourth quarter, when it launched to start off a new year, there was my all systems go breakout, and then we bought it that next morning and captured in actually 5 trading days to hit that 300% gain on the last piece. Notice how vertical these things can go once they get outside of those bands and basically all systems go. This is a thinkorswim chart. You see our ADX was starting to signal, but we really needed that confirmation above that resistance level right here. Once we broke that big R resistance, we were ready to roll. And again, great when you get new subscribers saying, first time getting going in many years of trying different services to start the service with a nice winner there. So I appreciate Srikant's note there. Bottom line is that we can't guarantee any one trade, but it's about putting the odds in your favor over a lot of trades. Same thing on the downside. Sometimes, I get these signals where it's like Alibaba was giving a signal, everything was broken down. So we were saying, okay, we've got a great chance here to make some money on the downside. The stock was trading near 160, and we're having to buy the 140 strike puts at 97 cents, $97 a contract. We cashed in a double the very next day, and that's the thing you got to get used to is that they seem expensive sometimes in some of these high volatility names, but the key is if you give it a chance to move, then you give it a chance. Even on a 5-point move down, we made 100%. So we're still well out of the money. We've gone from 160 to 155, and we're 15 points out of the money, and we're making a double the very next day. We're up to about 150% on that next morning after when it dropped down a little bit further. But then as it flipped back up, we said, this is not doing what we wanted to do. We're going to take the 69% gain and move on. You see it just kind of flatlined after that. If it's flatlining, you're going to have problems with time erosion. So you can't afford to hang on to those trades. Robert Romine wrote in, he said he was having trouble. Then he started using percent R as one of the methods we teach, and he had a lot of success. His total portfolio almost tripled, and he had more 100 and 200% winners than he ever had in this past trading. So, and he was able to manage his risk too. So not surprisingly, he uses that as his primary trigger for all of his trades with some of the other indicators as filters. And that's essentially what we're doing here is adding in the things that work across literally I've tested hundreds, if not thousands of different indicator combinations to say what's the best of the best, and that's what you get here. One more on Akamai. You've probably heard of the cup and handle pattern, right? This is a cup, there's a little sideways, there's a little handle there, and then the thing's off to the races. Well, you can see the longer that base happens, usually the better off you are with that trade breakout having some power to it. We bought this. You can see there's our confirmations. We're buying that next morning, and we're kind of stuck sideways in it for 2 or 3 days. Started to pop up about the third day in, fourth day and fifth day, and we're positive. And then on the seventh day, we said, cash it in and then let's rest or let's look for new opportunities is more what we did. What I want to show you in this chart is it's pretty cool. This is an intraday thinkorswim chart that's a 30-minute chart. And you start to see the same patterns even on short-term charts. So when you learn the Grand Slam method, you're going to start being able to take this and trade it on a variety of things. So you say, sure, there's a nice little window there where percent R, CCI, everything's looking pretty good for that window. But when ADX started trending through this 7th day holding period, look at how all those indicators or all systems go. And look at how vertical it is. We're getting all 3 of our profits right there in that steady vertical ascension. And then they announced that overnight that they were adding a new board member that was looking to unlock value in the stock, and that's why it then gapped up the next morning, but then immediately gave that back and had to sell the news. We'd already basically profited from all that institutional accumulation. You think they knew anything before that was announced? Of course. And that's what the price action shows you. So when you look at the keys to be a successful Grand Slam options trader, you got to have that catalyst. And for us, it's typically a technical breakout of all 3 of the indicators being together. Sure, if the earnings are coming or if they've been good, that's a plus. But we want to take advantage of that catalyst of action. And then you've got to buy them at $1 or less. If you start paying $2, $3, you start crushing your leverage potential to make that ultimate 300% Grand Slam kind of home run. And that's where that higher gamma options gives you that bang for your buck. What's unique about this is it's not just based on a price stop. Sure, when we start getting gains, we'll put in profit protection stops where we can kind of manage not letting winners turn into losers. But that first 5 days, if we're kind of waiting, if it's flat or against us, give it a little bit of a chance to go. Don't be too hair trigger to cut and run. That'll a lot of times cost you. You'll turn a winner into a loser. We want to keep those trades until that 5 trading day window closes, and at that point we'll cut and run, and we will book some losses when it's not fired after that 5 days. So that's why it's also important not to overcommit your capital. So we got those targets in there, and then 5 to no more than 10% of the capital you allocate to trade the service should go into each new trade. So, if you have a model $10,000 portfolio, we're saying don't put more than $1,000 in. We always encourage people when you're getting started, start small and build. You also get weekly video training from me, so I do a weekly video for Grand Slam subscribers where you can really take advantage of this. If you came in late, so we got started here, in the last 4 years, you can see on all the trades I did, winners and losers. You follow that same, no more than 10%, about $1,000 on a $10,000 portfolio per trade. So whether it's priced at $1 and you get 10 contracts, if it's priced at 50 cents, you get 20 contracts. It's not about getting the most contracts. It's about really taking advantage of the right kind of option. That was a $10,000 portfolio up to more than 32,000. That's a $22,000 profit. It's not that 10 went to 22, it actually went to 32 and left you with 22,000 in gains before commissions. Of course, commissions are down to next to nothing, so it's a great time to be trading. And what usually for my subscribers, it'll cost a couple $1,000 a year, or even up to about $600 over 3 months. But what I've done here is I've set up a really great special for you. When you pop in this special link here that I've got here, and I'll type it in if I need to. Let me pop it in here real quick. That basically it's a members.bigtrends.com/slam page here. So basically it's not www, but it's members.bigtrends.com/slam. That basically when you go to that page here, let me send that over. That page will pop this very simple page up here. Let me show you this real quick. So when I pop that up here, I lost it here in 1 second. Members.bigtrends.com/slam. There it is. Okay, check this out. Popped it in there from before. So you'll see that I'm giving you a chance here to try for the next 30 days for just $47 a month. Now, usually my auto renew lowest price is $147 a month. So if you like it, I think you will after the 30 days. It would be set up to auto bill every 30 days at $147 a month thereafter. So we give you very clear terms and conditions where you can review. If you need to cancel within the first 30 days, you can do it. So there's no shipping, no taxes if you're not in the state of Kentucky, so where I'm based. So basically, bottom line is $47. You hit the green checkout button, and you see that you'll get your clarity about how you get started. All the bold fields have to be filled in to get you started. We take all the major credit cards. You can just say you saw it here on the webinar here with me, or that I assisted you, either way. Okay, so basically, and what I want to point out here is that this gets you set up for the email alerts real time. They can come out any time in the trading day, but I want to also mention that if you want to get them texted at no additional charge from us, just make sure you have unlimited texting, because we're going to generate about 6 to 8 trades a month for you. Not too hyperactive, but give you the best of the best signals. Text alerts to whatever your smartphone number is when you're getting signed up. And also we ask that you tell us what service you use. If it's Verizon, if it's AT&T, if it's Sprint, whatever you got, basically just type in what that is, and then you'll clearly have that on there. We do spell out also, this is an automated renewal program, so we pulled out that piece of the terms and conditions onto this page just to further remind you that, hey, after 30 days it will auto bill again, and so you know what that's coming up. If you needed to cancel it for any reason, you got clear ways to do so. And then review all that. Click that you understand that, and then hit the submit order button once you review those terms and conditions. Then you're good to go. Like I said, we're on our 22nd year here at Big Trends. It's been a phenomenal run across a tremendous market to be buying option premium. One thing I didn't really talk about in the presentation here, but it's really one of the great reasons why it keeps working, is that volatility is staying relatively low. We've got the VIX, the volatility index, hanging in the mid-20s, and yet, so that means that it's projecting that these market moves could be like plus or minus 20 to 25%, and yet you're seeing the market move a lot more than that. You saw it move more than 30% on the downside last February, March, and then of course you saw what happened afterwards. The market rocketed up, the NASDAQ up some 50% last year, even with the pandemic in between there. So you're getting a lot bigger moves than what the market is anticipating, and that means you're buying actually relatively cheap options. So when you go to that page, we've already applied the coupon code for you, and you can really take maximum advantage of that.